We're rolling.
Hi.
Hi. Grey Rock Realty Podcast. We got Cat Barnett in the studio. Catherine, Cat.
Yeah, I'm a cat.
She's a cat.
I've just gotten lazy to shorten it.
Cat is a mortgage broker, loan originator. What do you prefer?
I would say mortgage broker, mortgage specialist,
Yeah.
or specialist. Yeah.
Cat and I have been working together for a while. She's been in the business a long time.
25 years.
25 years. And she knows her stuff. And we were talking the other day, doing a transaction, and she mentioned we started talking about divorce, and just it's a fairly high percentage of our business right now. And Kat's done many thousands of transactions in her career over the last 25 years, and divorce has been, unfortunately, a significant part of that. Just kind of is what it is, and there's a lot of topics to cover in that space. And so we just wanted to get together and kind of talk through that. And when clients call me up, they're typically asking, what's the house worth? That's sort of the first place you go. And usually somebody is trying to keep the house because of a low interest rate, but they also have got to get the spouse a big chunk of cash. And so there's a lot that goes on with that. So welcome, Kat, and appreciate you being here.
Thank you. Thanks for having me.
Yeah.
It's a topic that's kind of a taboo topic. However, it involves 50% of all marriages.
Right.
And it involves 60% of all second marriages and 70% of all third marriages.
Wow.
So you would hope by the third marriage, you're kind of a pro at the mortgage game.
Right.
But you oftentimes they're not. So they run into the same situations. There are many, I always call a divorce more of a financial restructuring.
Okay.
And I feel that most attorneys don't think of things that way. They think of things as a legal issue. And then most of your folks go without an attorney. You have 30 to 40% that goes without an attorney.
Wow.
So they're amicable enough to work things out, but how they set things up may not work on the lending piece.
Okay.
So I'm usually here to ensure that we're accomplishing their homeownership goals, be it currently, be it in the long run. And some of them also try to keep in mind of that generational wealth and leaving a legacy for their kids. So when they're amicable enough, it goes great because they're really trying to look out for each other.
Sure.
And they're willing to listen. The ones that have attorneys involved, those are more hostile. And although I love with the attorneys that I work with, I don't solicit attorneys for their business just because those are going to be the ones that I'm going to be called to court. I'm going to, it's going to be back and forth, very, very hostile typically.
Okay.
So, but the ones that I do that are amicable, those are usually amicable enough, right?
Right.
Those usually go pretty well. And the storyline is very similar from each couple with different nuances, right? The one that wants to keep the house, but can't afford to refinance in today's rates. They want to keep the low rate, but then they still have to pay out the X.
Right.
You have the other one who wants to buy another house with the proceeds that they get, but are worried about qualifying with, the current mortgage on their credit. And then it's trying to work with both of those of how everyone can be comfortable to accomplish those goals.
Sure.
And then, when you come involved is going to be typically when they just both decide to sell, go their separate ways, take their money and buy again, typically. Some stats, though, that are a little hindering is that when a woman loses their house in a divorce, they often never buy again. So, as real estate professionals, we want to prevent that, because we want to keep them as a buyer because that also creates wealth.
Right.
Mm-hmm.
Yeah. Yeah. And I think, one of the things that we think about too is like a lot of people that have owned homes for a long time think renting is like, they can't even imagine renting, right?
No.
And while I totally understand that, I think it's a fine option to like let the dust settle,
Absolutely.
Right? Because I've been in plenty of situations where, they're trying to buy immediately after and the dust hasn't settled.
Yeah.
And, if there's a new person in their life, that there's also a dynamic there. And we had a deal last year where, fell out of They basically walked away from the deal like the day before closing. So I just would encourage people also to kind of take a breath. It's okay to rent for a year.
Yes.
That's fine too.
I did that.
Did you?
So, yeah. So, in my circumstance, my ex and I, we had 3 homes.
Okay.
And he got one of them in the divorce. And I was able to keep the big marital home, which was my dream home. It was going to be where I raised my babies. And what I have found as I've been focused on divorces for the past almost 11 years now, every single one of my divorce clients, every single one of them, if they keep the house, all but one sold within 3 years.
I was going to ask you, is that like the emotional part of it where there's too many memories?
Yep. And the one that has kept the house, she's remarried, and I bet you she sells probably in the next couple of years. Like this guy's like, dude, this was your ex's house,
Yeah.
But so their life just changes. And sure enough, my divorce was 2015. And sure enough, 2018, I felt no matter what I did to fix it up to make my own home, it was like a 5,400 square foot home. So
right.
I was an empty nester. It was getting way too big. But I was trying to renovate it, put new carpet, make it more of my own. And it felt like putting lipstick on a pig. It just still felt like a pig. I never could rearrange my room enough to where it felt like my room.
Sure.
And so that's when I said, you know what? I am going to sell everything I own. And I sold every single thing in the house down to the plates.
Okay.
And I moved downtown Loveland in a 900 square foot apartment and 2 bedrooms. And I lived downtown, and I did that for about 18 months until I was like, where do I want to be? I was thinking downtown Denver. I was thinking wherever. And I ended up settling in a little condo townhome in Loveland.
Okay.
Yeah. But I felt like I needed the dust to settle.
Yep.
And complete restart. And I didn't give myself that when I first got divorced, and I feel like I should have.
Okay.
So just understand that 3-year mark is definitely something to pay attention to.
Yeah. Was the dynamic only you, or was it like new partner coming into the picture and like being in that space, or just?
It was only me.
Okay.
Yep. I stayed pretty single for 5 years.
Okay.
So it was only me. And yeah, that worked really well for me.
Okay.
Yep.
So let's kind of start at the beginning. When people
Yeah.
come to you, what's typically the first thing that we need to do? Is it value the house, or where do you start?
The question I get asked the most is going to be, when should I talk to you?
Okay.
And I'm like, the minute you're going through a divorce. And the reason being is that the conversation is going to start. Once you file a dissolution of marriage, that conversation is going to start on like, what happens to my assets? Where does this go? Where does that go? Be it amicable or not, you're going to have those financial disclosures. And so you don't want to get caught agreeing to something in mediation, because that's hard to go back on. Agreeing to something in mediation when you didn't know you could deliver that. So oftentimes I get somebody who's already agreed to something in mediation, or has already filed the separation agreement, which is one of the last documents filed, and they've agreed to something that they can't accomplish.
Wow. Okay.
Yeah. So tap me in early. At any given time, I handle about 40 to 50 divorces a month.
Okay.
And that's just an ongoing process. In Colorado, your average divorce, this fastest divorce you can have is 90 days. So on that 91st day is the fastest divorce you can get.
Okay.
But your average divorces take about 6 to 9 months. So it's just an ongoing conversation that I'm having with folks of like, how are you structuring things? What do you want? What does he want? What does she want, et cetera? And so right at the beginning is what I want to talk to them right at the beginning if possible.
Okay.
Conversations for me go like, what are your homeownership goals? What do you want?
Yeah.
Right. What does he want? What do you think he wants? Or what do you think she wants? And so we try to establish that. And then I try to address specific obstacles when that happens, because if she says, well, I want to keep the house. Okay. Do you qualify to keep the house? What is your interest rate at? What is your value? That's when I'm tapping you in. How much do you think he's going to want from that? Because people in general tend to segregate their debt and segregate their assets, right? To where they go, oh, I've got $300,000 in my property and I want to split that 50-50. I want $150,000 of that. And you're like, okay, great. But I have $600,000 in my retirement. Right. Okay. Well, maybe you don't get $150,000 and you keep your retirement. right? So there's different strategies that we try to look at, but I always tell people on a simple math, the way that Colorado looks at things is that you're going to take all of your assets, add them up, take all of your debts, add them up, divide by 2, and that's what you're trying to sort out as fairly as possible.
Sure.
So then it goes, how do we sort it out?
Right.
You know, and trying to get what everyone deserves and be as fair as possible.
Okay.
Yep.
So let's talk about the cash out refinance option, because that's usually being discussed. And from my perspective, when I'm valuing these properties, I can say that, we're sure that we're going to get this amount. Always going to err on the side of being low, right? Because especially in the market right now, I feel like we're having to price a little bit below where comparable sales sold 6 months or a year ago. Because markets, corrected a couple of points. It's not too bad, but we've got to make sure we can deliver the price that we're, giving them on the report.
Yeah.
And we do, create a home valuation report in writing, and that can be used, may not require an appraisal as well. Sometimes you need, multiple appraisals. But one of the things that I've noticed with cash out refinances is that there seems to be almost like an unspoken kind of wink wink agreement between the bank and the appraiser that if somebody is doing a cash out refinance, in my experience, that appraisal tends to come in a little bit lower than what I think we could get on the market. So I don't know if you've seen that, or,
Well, usually the appraiser doesn't know.
Right.
So
okay.
when the order hits the appraiser, they just know this as a refinance.
Okay.
Okay. With that being said, depending on how it's structured in the divorce, in the separation agreement, it may not be a cash out. So if it is court ordered, let's say, you have 2 parties, husband and wife, and it's court ordered that the wife has to refinance and pay out the husband. Once that is court ordered, it is not a cash out.
Okay.
Okay. Which 90% of your lenders don't know that.
Okay.
So they'll do it as a cash out and charge them a higher interest rate because they don't know any better. So it's not a cash out. So it's a rate and term refinance. And oftentimes we get appraisal waivers on rate and term refinances.
Interesting.
So we just set it up as as almost like a second mortgage that we're paying off. That was a purchase money second, basically.
Okay.
Now, sometimes, especially if we're trying to keep the great rate, they're doing a home equity line of credit,
right?
In which, depending on that value, you may or may not need an appraisal. Depending on the amount that they're getting out, you may or may not need an appraisal. When it comes to the wink wink, there's usually not any of that going on.
Okay.
But appraisers with refinances in general tend to come in a little bit lower because I feel they don't have the guidance of, hey, this person's willing to pay for this.
Sure.
Right. So that's where I see appraisals come in lower, not necessarily because of the structure or the type of the appraisal being ordered, but just because they don't have a contract telling them what to do.
Right.
Yeah.
Okay.
And that somebody's willing to pay for this. Not that always leads an appraiser to value something higher or lower.
Right.
It just when you have a buyer willing to spend X amount of dollars, that gives a first indication that the home may be worth this.
Yeah, it's a data point, right?
Yeah.
And a lot of the appraisals do come in right at the contract price, and people kind of think, well, that's sort of silly, but I think it is a data point the appraiser has to take into consideration. And as long as the other comps are backing it up, that's probably where they're going to value the property. So
yeah. I used to always say on the divorces, especially depends on the county and the judge, but I was like, hey, if you guys are doing this amicable, I would suggest getting an appraisal, whether you're keeping the property or not, it depends on whatever terms, right? But if you need an appraisal, half of my judges come back and say, before I'll accept the separation agreement, we want an appraisal.
Okay.
But the other half are like, okay, we'll take comps. We're fine. So It's not across the board as I thought it was.
Okay.
Mm-hmm.
Let's talk about alimony. And of course, a lot of people are going to be counting that alimony payment towards their income in order to qualify for the new property.
Yeah.
What are some of the dynamics to think about there?
Same thing for child support. So child support, you don't necessarily get a choice on. So child support is a calculation that the state has to determine who owes what based on the time they have with the child, based on how much money they make.
Okay.
Alimony / maintenance, Colorado calls it maintenance. Maintenance is determined on the disparity of income and who makes more, how long they've made more, how long the other person has made less, and what they're agreeing to. This one's going to be more argumentative, to where you can argue back and forth. You can leverage assets to argue your maintenance. To go, hey, I won't pay out this house. I won't have to give you a buyout if you'll waive alimony, right? So there's little different things that they can do. When it comes down to qualifying, you have 5 agencies. You have FHA, USDA, Fannie Mae, Freddie Mac, and VA. All of them consider the history of receiving alimony and child support differently. Okay. FHA loves to see 12 months and conventional loves to see 6 months.
Okay.
Okay. So we have to show that they've received it. Temporary orders counts, even if it goes up or down the line,
Okay.
That they've received it for a minimum of, let's say, 6 months. And then that we have to show it's going to continue for 3 years.
Okay.
In Colorado, that the child is 19. At 19, it ends.
Okay.
So if I have a kiddo that's 16, I can't count the child support. So
Interesting.
yeah, because
Okay.
it's not going to last for 3 years.
Wow.
Yep.
Okay.
So the timing, again, chatting with me, we've got to time this out. How soon do you need a refinance, or how soon are you purchasing, and how long do you have to receive the child support or maintenance for in order to qualify?
Right.
And I had a client that if she was to proceed without me, would have lost her house because her ex had said, hey, I'm just going to pay you a flat $60,000 and that'll be your alimony / maintenance. And she almost accepted it. And I was like, whoa, 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 whoa. And I go, here's the thing. I can't qualify you on that amount of money. And I need the income because you've been a stay-at-home mom, part-time nurse. So I need to get more income in there. And we have to show that you have to get it for at least 3 years. So we structured it so that she was receiving enough income and that it would last for like almost 4 years.
Wow.
That would give us 6 months to do the refinance and all that jazz.
Wow.
Yeah.
So many people are not using attorneys. You're kind of saying, like, when attorneys are involved, it gets acrimonious, but at the same time, you're seeing people not being represented well.
Yeah.
Talk
Both.
about that. Yeah.
Both. I think they're, I love my attorneys, right? But they don't love me as much. They don't, right? They don't see the value of what I'm offering until they do. It's like I meet with an attorney this Friday and he's like, I've never been willing to meet with a mortgage broker. I've never been willing to meet with a real estate agent or a lender in my whole entire career. And he's like, but after hearing what you've told my client, I need to meet with you.
Interesting.
So now he sees my value because I don't think attorneys have much respect for us. And I think they're solicited incorrectly very often. And we don't pay their consult fee, but, now he's more than willing to chat with me and go, okay, I need to be paying more attention to how we're setting things up for my clients.
Right.
And so that's where I found with my own attorney versus, trying to do this on my own, of what my attorney didn't know in my own divorce. And if I, who at the time I'd been in lending for 15 years, if I felt a little bit alone and a little bit like, oh my God, people aren't paying attention to what I'm trying to do. They're just trying to get the legal matter done. They don't care about my financial future.
Yeah.
Yeah. So the attorneys that are willing to listen to me, I'm grateful for, and I'm sure their clients are grateful for, but on the attorney side of things, I don't think I'm tapped in soon enough.
Okay.
To help them structure the deal. They just kind of go rogue. And next thing you know, I get a separation agreement where the alimony is less than 2 years. And I'm like, okay, sorry, I can't use that for you to buy a home. What do you mean you can't use that?
Yeah.
Can't.
Yeah.
Yeah.
Let's talk about VA. I assume that if one spouse is a service member and the other is not, and they split up, the spouse that's not a veteran cannot use a VA loan. Is that correct?
No, not true.
Not true.
So once a divorce is, once it's court ordered that one party or the other gets the home, all homes are assumable.
Okay.
All loans are assumable. So in normal basis, your only assumable loans are VA, FHA, and USDA. And USDA is a tough one to assume, but those are the only assumable loans. But if it's court ordered that this person gets the house and they are given X amount of time, which they take about 6 months to assume, all loans are assumable.
Wow. Okay. Obviously, as long as they qualify.
As long as they qualify, which that's the biggest obstacle because they usually adhere to a manual underwrite. So manual underwrite is pretty strict guidelines. Like for us on a normal automated underwrite, we can go up to 50% debt to income ratio.
Okay.
On a manual, it's a 29 front end ratio, which is a housing ratio, and a 42 back end ratio, which is housing plus debt.
Okay.
So a lot of what my job is, and part of the package that I offer is to make sure a borrower can perform an assumption before they agree to an assumption. So because we'll get the details of what the other servicing companies' guidelines are.
Okay.
And make sure that they qualify for that.
Okay.
Yep. But going back to your question on VA. So first of all, VA loans are assumable even with non-vets.
Okay.
So if you were to sell your house with a VA loan and you had an investor come in, they can assume your VA loan. The caveat to that is that service member's entitlement is not released until that VA loan is paid off.
Okay.
Okay. So not to get in the weeds of things, but a VA borrower has an entitlement, and if you tie it up into one home, you're going to be restricted to be able to purchase another home based on the value. So in general, you can get a VA loan with zero down. If you have part of your entitlement, let's say you have a $500,000 loan, right? You have $500,000 loan that now you had somebody assume, so you didn't get your entitlement back. You can buy for 100% financing up to the conforming loan limit, which today in 2026 is $832,500.
Okay.
So they could only buy at 100% financing, $332,500. They could go higher than that, but then if they go like $100,000 higher, they have to put 25% down of that 100,000.
Okay.
Okay. So while it's possible, it's not ideal. But, depending on negotiations, if that person wanted to keep the VA loan in the divorce, they could assume that VA loan as long as that service member was willing to keep the entitlement tied up.
Okay.
Yeah. So that's something to consider.
Interesting. Okay. So let's talk about if you want to keep the home, you've got a chunk of debt service on the house that's at a very low interest rate, but you also need to, pay off your spouse and get them on their way. Is it always, a home equity line of credit? Can we ever put a second in place in order to keep, the first at that low interest rate? Because obviously if you're doing a whole cash out refinance, you're refinancing the entire debt and you're going to be at today's market rates.
Yep. What I analyze is what is the hybrid rate?
Okay.
So, your home equity lines of credit sits at prime. Your second mortgages sit a little bit higher, usually average around the 7 to 8% range, depending on the situation and credit. So if you have somebody who is sitting at a 3 or 4%, maybe they have mortgage insurance, right? So I'm going to look at what's the hybrid rate and does it even make sense for them to not refinance?
Okay.
Again, we segregate debt. So all we can think about is, I've got a great rate over here, but then this second or HELOC is going to be a little bit higher, a lot higher. And then how much of that is going to be higher? If you have $130,000, you at a 3.5% interest rate, but you got to do a $250,000 HELOC at 7%, that doesn't make sense.
Sure.
And then on top of it, you've got other debt to consider. So usually your divorces, each party is going to have debt that, I always say whenever you get a divorce, you make sure the debt is clean, no ties. You don't want somebody to have a credit card in your name, an auto, make sure that your divorce proceeds are paying off debt. And that's where I work real closely with my title company. I won't do a divorce without her. And we make sure, we had a gentleman where his ex had racked up $70,000 in business debt, starting a new business right when they were getting right around the divorce period. Okay. And he's like, I don't want to be stuck with that. And so what we did is part of the court order, and they were working with attorneys, and part of the court order was that she would be granted, because if you were to include debt into the proceeds, that he would have to pay off this debt and her, it's considered a cash out. And then I have to follow cash out rules. Okay. But what we did is we said, okay, she gets $150,000 of the equity. Of that equity, before she's paid the equity, you have to pay off the $70,000 visa that she's racked up.
Wow.
And so, but if you put it underneath, it's now still a rate and term. And this dude was a VA. So the minute I did a cash out, he was hit with a 3.3% funding fee. So we did not want to do a cash out.
Sure.
So we structured it so that underneath that cash out, that equity buyout, the title company was instructed to pay off the debts, which not every title company, I'm dealing with a title company right now on a purchase. She's selling her home. The title company refuses to even read the separation agreement. And they go, that's not our legal obligation. And I go, but the separation agreement states that she owns the home. The payout to her on the sale of this home is to go to her. And they won't do it. And I said, find another title company.
Wow.
Yeah. So they're finding another title company.
Right.
Right. They're just choosing my gal. So I
Okay.
was like, yeah. But that's, those are the tough conversations, just the ins and outs of transfer of ownership.
Yeah.
Yeah.
What do you think we haven't covered that you want to talk about?
Let me see here. Good questions.
I think from my perspective, a lot of the time when we're selling the house, both spouses are kind of done, right?
Yeah.
And there's a lot of times plenty of stuff to do when you're prepping a house for sale, and it really makes a difference as far as this final sale price that we get. And usually one spouse is kind of carrying the load of getting it
Payments,
prepped and
yep.
ready, and spending the money to get that stuff done. And is that being documented so they're getting reimbursed? And so that's something a lot of times we'll just take as much of that as we can, right? And whether we need to kind of build it into the agreement so that it's on the settlement statement so that they do get reimbursed.
Yep.
That's a big part, because I can't, we can't just have them leave the house. I mean, the other day we were, we had water shut off, it's in the middle of winter.
Oh God.
We had heat, shut off. So we've got to make sure that, that stuff is being taken care of, and that those costs are being shared.
Yeah.
Because those properties just, we can't have pipes bursting.
No, that's going to be a far.
And even just stuff like, cleaning the house and staging it, and, small repairs that make a big difference. We needed to be able to take that burden off of them and then document the money that's been spent. So
Yeah, I think the most valuable thing you can do from the real estate side of things, and oftentimes I know folks don't like to do this, but get a full inspection before you list it. And that way, then you're going to both parties and saying, these are the issues that are going to come up.
Right.
I will say 99% of all buyers hire an inspector, right? These are the issues that are going to go up. These are the bids or come up. These are the bids that it's going to cost. And I would have that prepared from the get-go and say, these are ways we can structure it. These folks are happy to provide this service and be paid at closing, but that means the deal has to go through.
Right.
Otherwise, you're going to foot the bill. And so I think having that up front, you can also use the same tactic when somebody is keeping the house. So I had a gentleman, he had 4 boys, really rough 4 boys, and 4 dogs. And this house was trashed. But she was like, hey, there's 3. He wanted to keep the house. She is like, hey, there's $300,000 of equity in this house. I want my buyout of $150,000. And I was like, but this house, in order to even get it sold at what you think the value is, this has to be done. So we got an appraisal, we got an inspector in there, and we got bids in there. And the repairs that this house needed was just over $100,000.
Wow.
So they cut that off. The judge cut that off of the $300,000, and they settled to split $200,000, which she got $100,000.
Okay. So you had contractors go in there and estimate flooring and drywall and all that stuff.
Yep. Yep.
Cool.
So, that's great for while this is going on, before the divorce is final. But in your circumstance where you're working with both parties, the other thing I caution folks on is that selling before the divorce is final. So just because the bargaining chip sometimes is the house, sometimes it's the only bargaining chip. And I get real reluctant to have people do anything prior to the divorce being settled. Doesn't mean you can't. A lot of people think that you can't. But you can make housing moves while you're in the middle of a divorce. A lot of people feel, most lenders and agents will say you can't do anything, that the minute you file for divorce, everything is frozen.
Okay.
But you can make housing moves while you're in the middle of a divorce. Just understand that marital assets are marital assets. And you want to make sure everything is going to line up correctly. And so that's where I always say, wait till everything is final, because on a lot of my amicable divorces, they're amicable until they're not.
Right.
Right? Like somebody finds out he's cheating on me.
Yeah.
And then all hell breaks loose. And that's, to put it kindly, like everything that they had agreed to. Like I would have great conversations in the beginning. And then next thing you know, she finds out he was having an affair. And then everything is completely out the window and they're out for blood.
Right.
So I always say, wait for everything to be final and then make your housing moves.
Okay.
Yep.
So, I mean, is there ever a scenario where you should, sell before everything's final?
I would say when foreclosure is at risk.
Okay.
Yeah.
And a lot of divorces are because of financial strain.
Absolutely.
So
Most of them.
certainly on the table, but usually you can kick that can down the street a little ways.
Yeah.
Yeah. I mean, I think, and communication is also a huge thing. A lot of folks come to me when, husband and wife both maybe have a realtor they already have a relationship with, but they don't want to use the other realtor. And so they kind of want a neutral third party to come in. And yeah, it's just really important not to be communicating, because usually in a real estate deal, we will have a primary point of contact, right?
Sure.
And so we want to make sure that you can just sort of operate automatically talking to one person, but that's not how you roll in these situations, right? Everybody's got to be. And sometimes that's just text thread. People are used to texting, and just make sure everything's in writing and so that everybody's on the same page.
Absolutely. I try when I have both parties involved, unless if I'm speaking to one, I try to make sure I have the other on the line.
Okay.
Right. When I have both parties involved. When I don't, then, it's fair game. The one thing we didn't talk about as we're getting in line with communication here is that one of my biggest pushbacks that I get from the person not keeping the house. So the story that I always get is, let's just say the wife keeps the house, right? And she cannot refinance. She's got a new job. She still doesn't qualify. Mom and dad's willing to help. But she cannot refinance it, and they have a 3% interest rate.
Okay.
Right. She can't assume either. And so, but they've got kids and they don't want to move the kids. But the husband wants to buy. And so the biggest objection I get is that, well, I can't have her keep the house because I can't qualify with that house and buy another house. Once the court order it awards her the house, we no longer have to count that house against him with all agencies but USDA. So most lenders will say, oh, you need to have 12 months of on-time payment to not count any of the debts. That is all debt. So if she's awarded the credit card and the auto and the house, we no longer count that credit card, the auto, and the house against him.
Okay.
And that's immediately. So sometimes my conversation with folks go, you don't have to do anything. You don't have to force her to refinance. You don't have to force her to assume, and you could turn around and buy. So if you guys are amicable, set up an escrow account that if she does get into financial trouble, you guys are pulling from that escrow account for 3 months. And then if after she's missed 2 payments, then you can force a sale.
Okay, so one spouse, there's both still on the mortgage.
Still on the mortgage, still on the title. I never tell any of my clients to be taken off of title if they're still on the debt.
Okay.
Because the last thing you want is to have debt on something you don't own. You have no control.
Yeah.
You can't even put it up for sale.
Okay.
So if they do nothing and they're amicable, right? And a lot of these go this way. They're amicable, they do nothing. And then we can also put in the clause that every 6 months to a year, she's going to try to refinance or assume. And then again, if he can monitor the payments and she has to verify that she's made a payment by the 5th of every month. And if she's in trouble, she has to communicate that. And they can pull from this escrow account that is established between the two of them.
Okay.
And then after the second payment, he can force a sale. I've only had that once. But nothing's messed up on the credit, and they forced a sale.
So if you end up quitclaiming one spouse off of the deed, is there, let's say the spouse is going to stay on the deed and on the mortgage, may not qualify. Can you quitclaim? Can you get out of the mortgage? Or is there there's a due on sale clause that comes into play and the bank's like, wait, we got to make sure that the remaining spouse is qualifying? Or
yeah, I mean, that doesn't happen very often, although technology is getting smarter. I would never quitclaim off of title if I'm still on the loan.
Sure.
So if she's awarded the house, but per the court order, she's awarded the house. But I would never remove that other person until I can physically remove them off the loan, because by quit claiming, it does not remove them off the loan. They're still liable for the loan. And now they have a debt that they can have no say in.
Okay.
Yep. So I would never advise people to do that.
Sure.
And that's one of the most common advice. I mean, the gal that I have the closing on, that we have to find a new title company. He was supposed to quit claim off the deed, off the title, and he never did, which was smart. But that's what the attorney advised him, is to quit claim off the deed. And I was like, how you're putting your client in a crappy position, because now he has no control over a house if she ruins his credit.
Right. But he's still on the mortgage.
Right.
Okay.
Right. Now, caveat, once the divorce is final and any debt that's awarded to the other person, if they're late or foreclosed or what so forth, if the divorce is final, as a lender, we don't have to count it against the person who wasn't awarded that. The problem is his credit is still going to go in the crapper. And the creditors don't care. And so they're still going to come after him. We can overlook that, but it's a manual underwrite, which means a higher interest rate, which means his credit score is crap, which means a higher interest rate. So that's not a good scenario.
So anytime someone's being removed from a mortgage, is the bank going to check to see that the remaining spouse can qualify every time?
Absolutely.
Every time.
Yeah.
Okay.
I mean, you mean removed from the mortgage via quitclaim deed?
Well, I mean,
or are you just saying in a refinance? It's either going to be an assumption, which they also call lien release.
Okay.
Because you can't really assume debt you already own, but the standard is calling it an assumption, but it's really a lien release. And so if she is going for an assumption or a lien release, they have to qualify.
Okay.
Just as if they were refinancing.
Got it.
So we'll often see people get their folks on board, get a co-signer on board, get a new partner on board to help them either refinance or assume. The other issue with assumption is that in order to assume, you have to make sure you've paid out the spouse the buyout that you agreed to.
Okay.
Because they will not allow you to assume without doing that.
Got it.
Yeah.
Man, there's a lot there.
Mm-hmm.
What else can you think of? Anything else you want to cover? I mean, I know we've and a lot of this, gets very technical really fast, and maybe people's heads are spinning
in the weeds.
But obviously we just kind of wanted to, just talk through some of those issues and just let people know that, somebody like Cat is on this and does a ton of these, and she's just an incredible resource.
Yeah.
So.
And they're certified professionals and people who do this for a living, and lean into them. Even if you're hiring an attorney, it would be the same thing if you're trying to evaluate a business, right? These are your finances, and oftentimes people just think that the attorney is looking out for their best good or for their own good, and then they often think that I know what, as borrowers and homeowners, they think they know what's best, but it doesn't always work on the other side. So as you can tell quickly on this very quick podcast, how far into the weeds we get.
Yeah.
Which means your house is part of that weed.
Yeah.
And you could really set yourself up for failure if it's not done right.
Okay.
Mm-hmm.
So there's somebody like yourself,
Yep.
Obviously. There's attorneys, any other people that, you bring in, financial planner.
Absolutely.
Yeah.
Yep. So I'm a CDLP,
Okay.
which is a certified divorce lending professional. There are equivalents in the financial world. So your financial advisor, there's equivalents in the real estate world. There's equivalents in the insurance world. So there are designations that your professionals can have that specialize in divorces when they know how to get into the weeds.
Yeah.
And they know how to go through that so that they're weighing everything out.
Sure.
Yep.
Awesome.
Yeah.
Well, Kat, this has been incredible. Your knowledge is super deep on this, and it's just fun to hear you let it fly. And
who would have thought talking about divorces is kind of fun?
Yeah.
I mean, aren't we all having fun here? I'm having fun.
Really appreciate, yeah. I mean, you just coming on and letting people, yeah, it's just great to think about that. Something I hadn't really thought about. You think of an attorney being a fiduciary, but yeah, I mean, you got to get some more cooks in the kitchen, and I
Right.
think it's gonna help you out.
Yeah, attorneys don't know lending laws or lending
Right.
rules.
Sure.
They don't know tax laws very well. So you get into capital gains issues. They don't know retirement laws, to where there are certain programs that can facilitate retirement without you having to pay penalty. So take the attorney for the legal law that they know, and then tap in those that need to help you where you need it.
Sure.
Yeah, there are people available.
Okay.
Yeah.
Well, Cat Barnett with Loan Fit, we're going to put her contact info in the show notes, and appreciate you guys listening, and thanks so much for your time.
You're welcome. Thank you.
Awesome.
All right. That's fun.
That was great.